Hello traders, Hiking Ashi Trader here, and welcome to my YouTube channel, where it's always about trading and freedom. Most traders keep asking the same question: when should I buy or sell when you want to go short? They search for the perfect entry, the best indicator, and the most reliable signal. But hardly anyone focuses on what may be the far more important question: when should I get out? Because you can have the best entry in the world with a poor exit, you still won't make money. You may enter at an excellent price and the trade immediately moves in your direction. You're well in profit, but then you fail to take the profit. The market turns and the unrealized profit disappears, and you may even end up closing the trade at a loss. I think we all know that. Conversely, even an average entry can become profitable if you manage the trade well and exit at the right moment. So the entry merely gives you an opportunity. What you make of that opportunity is decided by the exit. Imagine three traders entering the same market at exactly the same time. All three buy at the same price, so all three have the same entry. At first, the market moves in their direction, but in the end, one trader makes a nice profit while another even exits at a loss. How is that possible? It's very simple. They choose different exits. The first trader takes the profit early. The second one lets the trade run and trails the stop. But the third one waits too long, gives back the entire unrealized profit, and eventually exits in frustration. The same market, the same entry, three completely different results. And this shows that the entry merely determines where your trade begins. The exit decides what ultimately ends up in your account. The entry hasn't made you a single dollar or a single pound or whatever. It merely opens a position and creates an opportunity. The money is made only when you exit. And as long as the trade remains open, all you have is an unrealized profit. That profit can grow, but it can also disappear completely within minutes. Only when you close the position does the opportunity become an actual result. That is why your entry does not decide how much money you make. The exit decides how much of the market move actually reaches your account. And what is interesting is how obsessed so many traders are with entries. Everything seems to revolve around the same questions. When should I buy? Which indicator provides the best signal? Where is the perfect entry? And a large part of the trading literature and almost every trading course deals with this question in great detail. By contrast, surprisingly little is said about exits. Yet no money has been made at the entry. You have merely opened the position, that's all. Everything you see on your screen after that is initially just an unrealized profit or loss. Only at the exit does the trade produce an actual result. Perhaps traders like focusing on entries because an entry is relatively easy to define with fixed rules. With an exit, however, you must make decisions while real money is already at stake. That is precisely what makes exits so much harder and possibly more important. So why do so few traders study exits in detail? The entry is simple. If the price reaches this level, the indicator gives a signal and the chart pattern looks right, I enter. After the entry, however, things become more complicated. Suddenly, real money is at stake and the situation changes with every price movement. When the trade moves into profit, you ask yourself, should I take the profit now? Or will the market continue to run? If the price pulls back, you may hope for another move in your direction. If you exit and the market then continues without you, you are annoyed about the profit you missed. And when the trade is losing, the opposite often happens. You do not want to exit because you hope the market will turn around again. That is precisely why exiting is so difficult. You have to make a decision under uncertainty while fear, hope, and greed are already influencing you. And no matter when you exit, hindsight will almost always reveal a better moment. Therefore, many traders judge their exit by what the market does afterward. If the price keeps rising after they sell, they think, oh my God, I got out too early. If the market turns immediately after they exit, they believe they did everything right. But I think that is a mistake to think in that way. At the moment you exit, you do not know what will happen next. You can identify the exit high or low only afterward. Of course, it would be ideal to close a long position at the exact highest point of the day. But let's be honest, that is not a realistic goal. Anyone who constantly tries to squeeze the final point out of a move will often wait too long and give back a large part of the unrealized profit. A good exit, therefore, does not have to be the best possible exit. It has to fit your rules, your risk, and your strategy. If you realized a reasonable profit and protected your capital, the exit may have been right, even if the market continued significantly higher afterward. So please do not judge your exit by the chart you can see later. Judge it by the information you had at that moment. So if the perfect exit does not exist, the obvious question is, how should I exit at all? Look, there is no universal answer, but there are several ways to close a trade. You can, for instance, define a fixed profit target when you enter. And some traders who use the Heiken-Ashi method do exactly that. They usually work with a risk-reward target. For example, if they risk $100, they want to make at least $300. Their platform can then calculate where the take-profit order has to be placed. And the system closes the trade at exactly that price, regardless of whether the market continues afterward. You can also use a trailing stop and try to stay in the move for as long as possible. The potential profit may be larger, but you must accept giving back part of the unrealized profit along the way. You can exit on a technical signal in the opposite direction. For example, when the chart structure changes, momentum fades, or a candle closes against your position. That's rather my method. I say more about it in a moment. Another possibility is a time-based exit. With my scalping trades, I often use this rule: if a trade still isn't working after 5 or 10 minutes, I get out. A good scalp should normally move in the expected direction quickly. And sometimes I simply exit manually because the market suddenly behaves differently from what I expected at the entry. None of these methods is inherently right or wrong. What matters is that the exit fits the strategy and is not improvised each time under the influence of fear or greed. So you do not need the perfect exit, but you do need an exit that you can repeat consistently. And that is crucial, because you have a complete system only when the rules for your exits are defined as clearly as the rules for your entries. The key is that the exit must fit the strategy. If you trade a short-term scalping strategy, you cannot wait for a major trend to develop over several hours. A scalp should normally work quickly. If the expected move fails to appear, a time-based exit after 5 or 10 minutes may already make sense. With a trend-following strategy, however, the same exit would be far too early. Here, you have to give the trade more room, tolerate pullbacks, and accept giving back part of the unrealized profit. Only then do you have a chance to capture the few large trends on which this kind of strategy depends. A fixed profit target must also fit the system. A strategy with a high win rate can live on many small profits. These traders are, in a sense, even more impatient than I am. They expect the trade to move into profit immediately. If it does not, they close it without hesitation. A strategy with a low win rate, on the other hand, needs larger winners to offset the more frequent losses. If you take every profit too early with that kind of strategy, you may destroy its statistical edge. That is why the exit cannot be viewed in isolation, in my view. Entry, stop loss, profit target, win rate, and average profit all belong together. Together, they form a complete system. You cannot simply copy the exit of a successful trend follower and apply it to your scalping strategy. And you should never turn a scalp into a long-term trade simply because it is losing. So, an exit is not good or bad in itself. It is good only when it fits the logic of your strategy. So how do I personally exit a trade? Look at how I do it, but remember that my approach may not necessarily be right for you. My win rate is relatively low, but every now and then I have a large winner. That large winner naturally pays for the many small losing trades. I do not always use the same exit method. My exit depends on how the trade actually develops. The most important thing for me is this: losses must remain small. If a scalp does not work after a few minutes, or if the market behaves differently from what I expected, I get out. The price does not necessarily have to reach my original stop loss first. Sometimes the absence of the expected movement is reason enough to close the trade. If the trade moves quickly in my direction, I first try to reduce the risk. I move the stop to break even and later use it to protect part of the unrealized profit. That still gives the trade room to develop. And at the same time, it prevents a good profit from turning into a loss. So now one example is my Nasdaq trade here from July 27. You can see it on the chart. I was long there at the green arrow at the bottom, 10 CFD contracts. At one point, the trade was more than $1,000 in unrealized profit. And as the move developed, I kept moving the stop higher. Eventually, I noticed some weakness in the market and closed the position manually. You can see it there at the green candle on top. 1 minute later, the first red candle appeared indeed. And as you can see, the market did correct and gave back about half of the accumulated profit. Now, In hindsight, you could say that I should have sat through the pullback because the market later climbed even higher and my profit could have been larger. But the real question is whether that is what I want. Do I want to give back half of my profit, more than $1,000, just to preserve the possibility that the market might move higher? Okay. At the moment the first red candles appear or the move begins to weaken, I simply do not know. So I do not consider that option. I exit and take the profit. My goal is to capture a good part of the move and not give back the profit I have already built up. Therefore, I'm not trying to exit at the exact highest point. I am trying to turn a good trade into a realized profit. So, what is the real purpose of an exit? It is not to squeeze the maximum possible profit out of every trade. That is something you can achieve only in hindsight anyway. The purpose of the exit is to turn your strategy's statistical edge into an actual result. That means ending losses before they become too large, realizing profits before they disappear completely, and, if possible, giving good trades enough room for some larger winners to develop. So what matters is not whether you could have made 10 more points on one particular trade. What matters is what your exit rules produce over 100 or even 1,000 trades. Sometimes you may take a profit too early. Sometimes a trading stop may force you to give back part of your unrealized profit. Both can be perfectly correct if they are part of the logic of your strategy. And look, a good exit will not always feel good, but it protects your capital and ensures that good decisions can produce profits over the long term. So perhaps you do not need a better entry system at all. Perhaps you simply need clearer rules for when to get out. And therefore, I would be interested to know, how do you decide when to exit? Do you use a fixed profit target, a trailing stop, or do you exit by feel? Let me know in the comments below. And if you enjoyed this video, give it a thumbs up and subscribe to the channel. Thank you for watching, and I'll see you in the next video.